Hello and welcome to the latest Insider interview. Our guest today is Richard Buxton, manager of the Jupiter UK Alpha Fund. Richard, thank you very much for coming in and speaking with us.
Not at all.
So can you please tell me a little bit about the fund? Where are you investing and what type of stocks do you like to buy?
The fund is designed to provide long-term capital growth through a concentrated portfolio of typically only around 30 to 35 shares. And I'm a very long-term investor in businesses, not a kind of short-term trader of shares. So there are stocks I've held for nearly 20 years in the fund. Now, I don't expect them to perform every single year, but if I still like the business, the management, the returns on capital, then I'm very happy if a company may pause in share price terms for a year, but if I think on a 2-3 year view I'm still going to make money, I'm comfortable.
And what are those shares you've held for 20 years then? And what are generally the sectors that you like to own?
Well, even with a 30 stock portfolio, you do want some diversification. So I do have a range. And I'm not a style-driven investor either. So I've got, reassuringly expensive growth stocks, and then I've got, some much cheaper value stocks. So you want a blend. Right now, clearly it's been a much better period for bank shares. I hold both Barclays and Lloyds because effectively, clearly for 10 years with 10 years plus with zero interest rates. I mean, if your product is money and the cost is zero, that's not a great background. Whereas clearly with interest rates having risen the last 12, 18 months, we've seen from recent results that, banks are back making reasonably nice profits. And because they've got all the capital that the regulators want them to have these days, they can give an awful lot of that back to shareholders through dividends and share buybacks.
Are there any sectors you won't invest in?
I haven't invested in tobacco for donkey's years. I mean, I just think, again, whilst they're very cash generative, in the long run, I just don't feel comfortable with the outlook for the future of those businesses. I'm comfortable investing in the oil and gas sector because actually, companies like BP and Shell, we're going to need them for a good many years, and they are managing the transition. They are investing in renewables, in wind and solar, and I think better to still work with the managements of these companies to improve and move quicker, rather than just disinvest and feel that you're somehow helping, but actually the planet is not getting any better.
You invest in both growth and value shares. Where is the balance at the moment?
Well, obviously we had a tremendous run in growth shares. When the only way was NASDAQ and tech, then the valuations of growth companies just expanded and expanded. And I was tiptoeing away from some of those names in favor of cheaper value-orientated shares. At the end of the day, the price you pay for an asset still does matter to the return you get from that asset, and for a period of time people seem to forget that. So yes, the portfolio, whilst it does still have some growth companies like Experian, Sage, UK tech company, there's more of a spread in the value stocks, and that's helped over the last 12-18 months because we have seen the valuations of those growth shares compress, and we've seen a bit of a re-rating of some of those value names.
You're a top quartile performer versus peers this year and last year. What has driven that strong performance?
Well, the market was pretty tough in the first 9 months of 2022. Clearly, markets falling, both equities and bonds. And the fund, didn't have a great time. But from the lows of October, when sentiment had got so poor, our own Bank of England was not helping by being so gloomy and downbeat. We actually saw, a very strong rally, and it has been led by a lot of those more cyclical names, consumer-facing companies. And as we've seen in the trading statements in the first couple of months of the year, actually Christmas wasn't cancelled. People did spend despite, the cost of living crisis. Consumer balance sheets are still in pretty good shape from the kind of enforced savings from the pandemic. Clearly an enormous skew as ever between the haves and the have-nots, and, very, very distressing. But in the main, as people, whilst they were cautious and sensitive as to prices paid, people did spend. So companies like Tesco and Next, Whitbread, which runs Premier Inn, these have all reported very strong trading this year.
And were those all companies you've held for quite a long time, which suddenly fell back into favour, or were they recent additions to the fund?
No. A stock like Whitbread I have held for nearly 20 years. Next, I've been a very long-standing supporter, and it's proved good over time. So these are sort of names I've backed for a long time.
So you are a long-term investor, but have you added any new stocks recently? What's caught your eye?
No, we've been doing a lot of work on one particular name, but we're just being a little cautious. We think that we want to see the next few trading statements just to make sure that actually, the growth that we think is there is going to come through. It might just be a little sort of difficult over the course of the coming months. But no, the last thing we did, back in October when the markets were really soggy, we just trimmed some of the positions in those commodity-related stocks that had done so well, your Shell, your Glencore, and just used it to add to some of the financial stocks that had been so weak. So we added to the Prudential. We added to Wealth Managers St James's Place, and they've rallied very strongly from the lows, so that was positive.
You invest in companies or UK companies of all sizes. How do you match the large and the mid cap elements of the portfolio?
I don't go down into the small cap world. I mean that I think we've got a very big small cap team at Jupiter. You need a lot of resource to meet all the companies. So I always have around 75% of the fund, 75-80 in the FTSE 100 names, and then maybe 20-25% in effectively the top half of the mid 250. So for liquidity reasons, I don't go down into companies that are less than about £1 billion in size. Now, a lot of people would argue, rightly, that small companies can double and double again, and in ways that large companies clearly are more mature and they're not going to grow at anything like those rates. But if you look each year at the difference within the FTSE 100 between the worst shares and the best shares, there's still an enormous performance differential. So if you can over time back more of the winners and avoid the losers, you can still deliver pretty good returns for investors. And yet you have no issue with liquidity or any danger of being sort of stuck in shares, etc. You've got instant liquidity. So that's the kind of style I've developed, running this fund for over 20 years now in various homes. And I think it's proven over time.
There's been a lot of reluctance internationally and domestically to invest in UK shares. Why is that? And is that holding back the market, or is that presenting opportunities which will come good in the long term?
Well, you're absolutely right. It's been not just international investors who have disinvested from the UK, but UK-based investors as well have sold. I mean, I think we've seen 6 consecutive years of outflows. And as a result, the UK market is definitely one of the cheaper equity markets out there. So, as far as I'm concerned, this provides a valuation underpinning, and I think there are good opportunities. But partly it's because, in the years when NASDAQ was performing so strongly, the US market, the lure of putting more money into global funds, which, well over half of which will be in the US, was very powerful, and it did deliver stronger returns. Whether with this shift now in interest rates and a move towards a more value-orientated market, that might start to see a few people revisiting investing in the UK equity market. Well, who knows? But we've certainly got, a valuation underpin that is very supportive.
You said there are companies that you've held for more than 20 years in the fund. Can we have those names?
Well, I've held about a third of the fund for more than 10 years. But those that have been in nearly 20 years or so, I mean, Whitbread, owner of Premier Inn, I think we must now be on the 6th chief executive during my ownership of it. Next has been a very consistent performer. They've managed that shift between bricks and clicks, superbly over recent years. There have been others that Experian, I've been in ever since it demerged from great Universal stores for people of a certain age to remember. And Burberry as well has been one that's been pretty consistently in the portfolio.
Richard, thanks for coming into the studio.
My pleasure.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.